Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
And we're back after a brief vacation last week due to local festivities and whatnot. Was refreshing, was relaxing, was very much due, gotta say, I needed it. But now we are back with the market. Well, actually, I was back at it on Monday, but really, as for the weekly market recap, we are back after a 1 week pause. Now, it was quite an eventful week this week with all the data points coming out and being released. But ironically, I'm not going to start out with the economic calendar this time around, but we are going to jump straight into the chart and we're going to get back to the economic calendar later on in the segment dedicated to equities because there was a nice type of point I wanted to uh, to bring up to light a little bit. It's just curiosity. It's not anything groundbreaking, but I was thinking it's interesting nonetheless. All right, so let's start out with the DXY as usual. Now, I remember last time I talked, we were talking about the 97 or 96 level, even to the downside as a potential target. We got close enough to the 97, kind of we spiked down to 97 and a half, and close enough to the deviation to the downside, considering the overall macro range we always talk about. Okay, so now point for me would be now that we made a low, very impulsive, a bit of exhaustion maybe. We bounced up and then we tried for continuation and we failed, and price was reaccumulated. So that is usually a nice formation for a little bit of a bounce. So the question becomes where to. Now, I think the first level of relevance would be that same range low on the macro scale and this tiny little cluster, which was to be considered as expected support, and it wasn't. So there was a clean break right in here. So the first level of attention would be right around this area in here, 100, 150, something like it as a region, right? In markets, it works like this, right? It's not a matter of being always and in any case absolutely precise. It's just more a matter of neighborhoods instead of addresses, right? So I would say in here, if we can extend this bounce a bit, I would expect a little bit of a starter step, but I'm still thinking overall we got the potential to bounce back. And, if we can reclaim the range, so if we can trade around 100, 101, kind of going sideways a little bit above the level, it could be your 2, 3 days maybe, then we can expand and extend these bounds into the 102 region, 100 and what, 102, what would it be? Kind of here. Well, I guess 102, 101, that that region right here. You got another level which is derived from the macro range right in here. So not bad at the end of it. So technically, that's what I would expect from the dollar instead of another washout. Now, two things are kind of in confluence with it. One, it's the chart of the euro, of course. And another one would be the usual sentiment on the DXY, okay? Because every single time you see the DXY going down like this, guess what? Guess what you got? The same talks about de-dollarization, the end of the dollar, the world rejecting the dollar as a global reserve asset. Yeah, okay, whatever. Now, uh, I tend to lean on the side that this time around it's the same as any other time instead of this time is different. So that that's why I would lean toward a bit more of a relief rally. I'm not saying it should, shoot back higher to the highs, but you know, a bit of a rally in here just to fill in this leg, and then we'll see. We'll take it from there. So again, I think I actually posted a kind of like a meme chart back, well, what was that? Maybe 2 weeks ago, which it would be quite ironic if overall it ends up being correct, but it was just bullshitting around. It wasn't something I would trade on, okay, or I would base any type of trade upon, right? Now let's have a look at, since we mentioned it, right? Let's have a look at the euro. So this is starting to look a little bit like a topping formation on the euro, which again, it should be a good confluence for a bottom formation in the DXY. Now, is it the absolute bottom? Is a long-term bottom? Well, I don't know. Probably not, but it's like I do trade week by week, day by day. Well, actually, when I do trade, I trade hour by hour. But anyway, it's just when I see something like this, right? I see an impulsive move to the upside in this case on the euro. If we want to take the euro as a proxy here, right? You see the first phase of exhaustion, the market getting back into a little bit of a stability, another push which fails, and you got price getting back violently into the range, and then being a little bit weak and unable to have continuation to the upside. And with Friday's price action, again, it sounds like we tried to rally up, we didn't manage to, and we were rejected, and we are back again to this base or level, whatever you want to define it. So 1, 2, 3 times. I guess if you ask someone, and even if you zoom it a little bit, there are there are gonna be people which are already seeing into it a little bit of a head and shoulder. Um, I I don't really trade head and shoulders per se, but what was interesting for me, it was the level in and of itself. And if you zoom out on the weekly time frame, what you can see is that we tapped back into this area right here. Okay, so we got a huge macro top, which was put in back in 2021. Then we got the break, a little bit of a tag back into the apex base right here. And then we went. And then from this point of release right here, it was just a straight collapse to the downside on a weekly time frame. And this was kind of untouched, was never retested. And guess what? The first time you retested it, that provided a very nice reaction. Now, on a weekly time frame, again, we can notice how these relative weakness in between the euro and the pound kind of fell apart because the euro was able to make new highs, the pound not yet. Doesn't mean it won't happen into the future, especially if the dollar keeps on being a bit weaker. All right. Although again, I just said I'm not expecting it to be weak at least next week, so we'll see. But it was interesting nonetheless. As for the yen again had a little bit of a pullback this week, but again we touched back in an area which was very sensitive. Previously. So again, another type of rejection at these levels. We got back into this pocket now. It's not bad in and of itself. I mean, still the trend to the upside, if you're just looking at the daily time frame, okay, it's intact. Uh, I I would expect to see the yen cracking down below these range right here, so these dealing range first, but most importantly, I mean, for me to say, okay, the yen is back to being fucked, I would wait for it to break these area right here. All right. Um, what else? Dollar Canadian again kept on going up. We got elections in Canada. I've seen Mark Kearney actually won. It's not up to me to decide whether is it for the better or the worse, but was like that. I guess from my perspective, it's just going to be interesting to see how the relationships in between Canada and the US are gonna, to shape themselves out now, because the President Trump and Mark Carney, it looks to me like they are on the opposite side of the spectrum politically, and with all the trade war, the tariffs, the borders. you know, might be some frictions in between the two. And quite honestly, I think, although I absolutely know nothing about, well, politics in general, but let alone Canadian politics. But the fact that they elected this type of leader while there was all these talks, which yeah, maybe they were just mimi, but making Canada the 51st state, yeah, could it be the population would so I don't want to say scared, but it would be easy enough for a political party to ride along that wave and to spin that narrative in order to gain consensus. Might be, right? So I think dollar Canadian for now still has a bit of room to go to the upside. Maybe not immediately. It's not that I'm expecting it, but I would prefer a bit, either a bit more of sideways before pushing up, or a little bit of a wash to the downside. Right, so another peak up lower and then resume the upside. Uh, the Australian dollar, it's at resistance now, but again, when I see these huge spikes and deviations out of dealing ranges so wide like these, then you see price snapping back in it, and now holding on the around the upper side of the range and starting to break in it. That for me is usually a much more bullish sign, although it's still some sort of a trap fractal, because we are trapped in between these area right here, okay, and this lower area to the downside, which, I mean, if you want to draw it, it could be you take the point of release, which originated the peak up, so the deviation, and then it was reclaimed or was flipped right in here. So again, up until the point price is stuck in between these area and these area, I would be on the neutral side of it. Or it's the type of situation where, at least in my experience, then again, it could be different for everyone, but in my experience, it's much more beneficial to wait for price confirmations one way or the other. Okay, so as for the other currencies, well, just two things. We've seen this move to the upside and this violent spike to the upside in the Indian rupee. I guess that was mainly due to rumors this week about the Trump administration getting closer and closer to a deal with the Indian government, with the entire topic and subject of tariffs, trade balances, and whatnot. Don't really think it's gonna make a difference long term. And even a spike like this, it's just, I mean, when you see something like this, usually the first thing you think of is just what type of news did we have? Okay. Uh, Same with this huge green candle to the upside. Now, I don't really remember when the supposed deal was announced, but I guess it wasn't on Friday. It was a bit prior to it. So this spike to the upside, it could be not related with the announcement itself. Uh, might be related to other type of liquidity dynamics. It was just nice to see that overall, at least in this period, the Indian rupee was a bit stronger than the rest. If you, let's say, if you look at the Brazilian real, the South African rand, and even the Chinese yuan. Now, bear in mind the Chinese yuan, okay? If you check the last week of price action, so let's say starting from here, right? What was that? April the 23rd, so last 10 days of price action, a little bit less than 2 weeks. Um, we are going to reference it when we're going to talk about gold a little while. Okay. Now, let's move on to oil, the one I got massively wrong. I guess I was just maybe I was too optimistic on this one. Now it's been 2 weeks, of course, so 10 trading days. But I remember I was aiming or thinking of these levels above price action because it was looking like a very orderly type of a drawback. We got this inefficient leg to the downside, so it was prone to a little bit of a pullback. I thought oil actually got a chance to pull back a bit more before being rejected or whatever. So overall, I mean, my thesis on oil didn't change in the last 2 weeks. I still think oil it's particularly weak. But just because you think an asset class is weak, that doesn't mean that it's gonna go wherever it needs to go in a straight line. Okay, markets got ebbs and flows as usual. So I was expecting a bit more of a pullback. We didn't have that. Now I quite honestly don't know if it was news driven or if it's just the fact that we are so fucked up in the global economy that there is really no demand for oil at the current moment in time. Now, fundamentally, I've seen, or at least I've read that OPEC Plus was talking about increasing production. We hinted at that. Oh, I guess it was a bit more than a month ago, so it's ancient history now, right? But the problem is that it's a cartel, right? The OPEC Plus, it's a cartel. They might say they want to cut production to try to sustain price, but if they are not successful at it, at a point they're gonna need to sell more barrels in order to maintain the same type of inflows when it comes down to cash. And since price actually deteriorated so much, now they need to sell even more barrels, which ironically bring price even lower because there is already a weak demand. And now you're increasing supply, so it's just supply and demand type of logics. Now, it's not only that, probably. It's also the fact that on the other side of the globe, we are talking about drill, baby, drill. So, probably the overall global supply of oil is increasing. And don't forget that, at the end of it, it's not that Russia, it's not selling oil. Uh, yeah, maybe the EU stopped buying oil and gas from Russia, but just because we stopped here doesn't mean that other nations like China or like India are not buying it from Russia. So it's not like that Russian supply just went offline. It's still gravitating somewhere. I find hard to believe the Russians just say, "Oh, the West just sanctioned us. We are fucked. We are not gonna export our most precious commodity, and we are gonna give up on our main source of income." That it's hard to believe that that's going to happen. So overall, I think uh, that could be a reason why supply was so high and demand was so low. I mean, uh, regardless what you think of the stock market, when you think about the overall global economy, it's not like things all of a sudden got better. If anything, if you had taken a look at GDP this week for the US, it looks like again things are getting weaker. And even if you take a look at the data on the employment situation in the US, and again, since the US, it's kind of like still the cleanest dirty shirt in the bucket of dirty shirts. If things start to deteriorate there as well, that tells you something about the state of the global economy as a whole. Now, I think at this point, there are two things we need to pay attention to. One is that if this is continuation and you see it like, let's try to draw it, it's probably going to be a mess. If you see like a move down, a little bit of a bad flag and continuation down at this point, you should expect continuation to the downside sooner rather than later, in my view at least. Okay, because if this down move is dragged out for too long, it invalidates the pattern a little bit, or at least it slows down the pace, the tempo, the momentum of the market to the downside. And at that point, right, if you see failure at continuation lower, at that point you would, I mean, you could, let's say you could start to think of some sort of a double bottom formation in progress. Sure, you would need to wait for price to come back up, starting to reclaim these levels once again and getting a bit more stable and manifesting and showing willingness to go up again. But you know, uh, for now, getting into the next 5 days of price action, my stance would be either it drops quickly, or in my view, the odds of immediate continuation would fade a little bit, and I would at least start to consider oil to get a bit more range bound as for the next few weeks potentially, kind of like what we've seen in here, right? If you remember, we got this massive spike to the upside, then we came back uh, quick enough. And then what you've seen is that we didn't have continuation. Like we tried one, two times, and at the end of it, oil stayed in a range for what? Another, what was that? Mid-November up to mid-December. So, an entire month, 3, 4 weeks of sideways. So that would be my stance on oil for now. Let's have a look at yields. Yields went up a little bit. I'm now looking at the weekly time frame. So if you look at the wick in its entirety, that's a green wick. Now, the previous wick was down. So at the end of it, they just pulled back this massive leg that they had on what was that? The basis trade scare. So we drew back the leg, and it looks like at least the long end of the curve, it's maintaining a bit of a bullishness. Okay, so which is in line with the current narrative of higher for longer, of course, which ironically it's on the opposite side of my long-term narrative, which would be they're gonna come down. But again, timing is always difficult, and now we are looking at a little bit of a bifurcated market, because you look at the long end, it looks like an uptrend overall. Then you look at the medium end of the curve, so that's your 10 years, right? And you see it's a bit more of a sideways market for now. At least it's been like that since November 2023. Then you look at the short end, and it starts to look a bit more like a downtrend, right? So, at the end of the day, who's going to be right? Still thinking, still leaning toward downside being the right path over the coming months. And again, we're talking months, not talking days. Uh, but fundamentally, when you pair it up with oil, for instance, there is a good enough correlation in the oil price and the rate of change in yields. So weak oil prices should reflect lower yields into the future. Uh, how long it's gonna take, I don't know. Guess nobody knows, unfortunately. But fundamentally, I still think that's the path ahead. I'm always open to be wrong, of course. As you've seen in oil, it happens, and it's gonna happen a lot. Like I will be wrong, of course. So conversely, bonds had a nice rally, to be fair. Uh, but last 3 days, the long end, so your TLT was just sold off. Again, didn't didn't really make new lows for now, of course, for now. So up until the point it doesn't happen, because you've seen we got close to it, right, in here, but then we just bounced back up, while the scares and the fears of the basis trades and the treasury market freezing out kind of faded away. The market got back in a situation of stability, right? Um, could we see a little bit of chop, and we don't really go anywhere? Could be. I mean, I guess if you are bullish bonds, that would be the best case scenario for now, considering the fact that, especially the chart on the left, it looks kind of bearish, quite honestly, right? And we are observing the same type of bifurcation in here, because if you look at the other, in the center and on the right, these tend to be, or to look a bit more bullish overall. So, take it as you like. I think it's just a matter to determine who's right, whether if it's the short term or the long end. I tend to believe the long end at the end of the day, it's what dictates your fundamentals drivers for the economy over a long enough period of time, while the short end could be impacted by many different things, Fed policies, short-term liquidity dynamics, in the repo market, in the treasury market, and even, it might be impacted a little bit even by what the government, so the administration, it's trying to achieve. I guess it's going to be reflected first in the short term, and overall over time, even in the long run, right? So we'll see about that. Um, let's move on to gold. I don't think there's anything else I wanted to say about bonds. If not, maybe there's one thing. But I guess at this point it's been a few days. But while we were in here, uh, and we got this type of rally to the upside, which again, it doesn't look like a lot if you're looking at it now with these three bearish candles. But there was a report by Bank of America, and it looks like in 2025 we had the biggest amount of inflows into the treasury market since, well, I guess 2020, or even even prior to it. So it, it's just another thing that I like to point out, because when people talk about nobody's buying bonds, nobody wants the bonds, yeah, are we sure about that? Because maybe, or maybe not. there, there is actually someone which is buying them, and guess would be interesting to know who is it, right? And if it's true, right, if it's true that everyone is selling bonds, namely China, how come if they're selling bonds forever now, why it's been what at this point almost 2 years, 1 year and a half? Why cannot we break the lows and keep on plunging? And if it's true that more new bonds have been issued, who bought them? Because if the major buyer is selling off all the treasuries, and if the US government it's keeping on issuing them, how come we've been in this dealing range for like more than 1 year now? Where is all the supply being absorbed? Who is buying them out? Because someone is, right? So, I mean, always be careful with these big assumptions and big narratives. They might play out over time. It's just, again, it's like my thesis with lower yields into the future. Uh, yeah, maybe sometime it doesn't really help me if, in the meanwhile, yields goes to, I don't know, let's say the 10 years go to 7% before collapsing back down to 3.5. Does it help you? Well, I guess not if you got money on the line, right? So again, just just try to be sharp and to be nimble, right? Now let's have a look at gold. Now gold had a little bit of a top information. Now I was particularly bullish on gold last time we recorded, which was, I guess, probably in here, I guess. Maybe even in here. Because that was a Monday, but no. So probably here. And then we got Good Friday. Yeah. Yeah, so sure. I mean, it's undeniable we hit a pretty relevant level, right? 3,500 even. So big figure, immediate reaction. Now, this bearish candle right here, as I was looking at it, just glancing at my phone here and there, it's easy to say now, of course, but it's just a commentary, it's just a recap, so who cares? But it was looking like a bit of exhaustion because you got one, two candles like these hitting a big figure, and then you got a day like this with a huge shadow to the upside. and price closing near the lows of the day. So, naturally, over the coming days, we got back, we feeling the first level of inefficiency. And this is another case where, as I was saying on the DXY, close enough is close enough. I was having this conversation and I was like, look, I think we touched, and I said touched, into this level already one, two, three times now, and it doesn't show any type of willingness to resume the upside. So I think we might really go a bit lower than this. And the objection was, well, no, we didn't really touch the level. There was quite a little bit of space there. And I said, look, yeah, I know I get the logic, but it might be close enough, it's close enough. So just because we didn't touch it to the T, I mean, at the end of it, the dynamic, the behavior, it's kind of the same. So just watch out for it. It might get a bit lower before eventually even resuming the upside. Because, overall, I'm still bullish enough on gold. Now, it's kind of like what we've seen in here. Although in here was a bit more, these three down days was a bit sharper. That for the odds of the same way he came back down into support, the odds for a sharp bounce were particularly high in my view. Instead of something like these, even the run up is different. We didn't have that huge spike to the upside, that exhaustion candle in here. And even the first day of pullback, it was a down day, but if you look at the shadow, there was a bit of buying activity in here. Like, right, instead in here, what you got, it's the complete opposite. The shadow is to the upside, and there is not a huge buying activity up until the point you kind of get into the neighborhood of the previous anticipated support. So I think, although I might retain my medium to long term bullishness on gold for now, I think in the very short term, we could see a little bit more of a pullback into it. So probably in this region that I highlighted in here, it's the problem with it. It's that it's a wide enough region, so it's hard to spot a specific level inside it. So let's try to zoom in. And I got a lot of different stuff. Let's do it like this. Yeah, there was old notes in there that I usually keep on a lower time frame, so they're not visible when I'm looking at the larger time frame. So where to? Well, I'll say this level right here, it's not bad. Was kind of like a support here, resistance, a little bit of a study step, and then he broke to the upside. So this 3,150 area wouldn't be bad. Below that, guess this one right here, 3,100. And if we really go for a deeper test, this could be even already retested to some degree. One, two spikes into it. If we go really crazy, 3,000, 3,050, something like it. But, I would wait a little bit to call for a test back down into the 3,000 area. So first and foremost, I would wait and see what happens. First of all, if we can crack this level, so let's say daily close below it, because if we can hold it, we still have the possibility to reaccumulate a little bit around it and then try to push higher again. Now, it is also true if you look at the, a large enough time frame, gold tend to go into these periods of consolidation. Sometimes it's just 2 3 weeks, sometimes it's 2 3 months. Overall, it maintains the bullish structure, but it could have some periods like these, right? I'd say stayed in this range from April up until what, July 2024. So again, don't discard that. if it goes sideways, and overall the market is going like this, being sideways for 1 month, 2 months, it's not the worst thing ever. It just means you need to have a bit more patience, right? And the problem again with the whole thesis right here is that in order to confirm some sort of a trend reversal right now, you would need to crack the 2,900 level right here. So again, it's like, yeah, so I would have confirmation of a trend reversal after we are what, 15% off the highs. Yeah, given the structure that the market is showing now, probably yes. I mean, unless you start to see something like this. Let's say you got this market hovering around this level a little bit. It tries to go up, it fails, it gets back down. It spends another few days or 1, 2 weeks in here. It tries again to go up, it fails, and then it keeps on going like this. Now, at this point, you might say, okay, you know what? Maybe this low right here at this point, considering the way the market it's trading toward it, probably it's not a huge support now because the market had a lot of uh, opportunities to keep on trading to the upside. But if it starts going like this, it starts to look a bit more like a redistribution. And at that point, it looks heavy. And I don't think a single low right here like this could hold. But again, this is just hypothesis way ahead into the future. All right. Let's have a look at what most people are, guess, cheering up for or celebrating, which is Bitcoin. All right. So now Bitcoin, where was it when we left it, or where I left it? When I left it, it was in here, and we were like, it's neutral up until the point it makes up its mind. Either way, down or up. What it picked the up trajectory, it looks like. Very sharp move to the upside. So we managed to break this area. We had a little bit of a stutter step around previous resistance, as expected, if you remember this resistance. So again, above 95, if you remember, I said, look, already cracking this area would be a good start. If we manage to crack 95, I was, of the idea that that's even better. That would be even a much better confirmation of a potential upward move. Now, again, would you say new highs? Maybe. I mean, if the rest of the market can really maintain this bullish posture, probably new highs. I still have a few reservations, but I would say at least the odds for it vastly increased now with this up move. I would have preferred to see a bit more of a pullback off of this region, to be fair. It doesn't mean, this is not necessarily bad. It's just maybe if we didn't really leave any type of inefficient price action behind us, it would have been a bit more constructive, a bit more structured, and therefore less prone to sudden and sharp drops. Now, that doesn't mean that even if it drops out from here and we get back, let's say, into the 92, 91, it wouldn't be a buying opportunity. But, I guess for those who already bought, they would gladly avoid that type of scare. All right. So beside that, I think, if we go level by level, next would be this pocket right here. So basically 100K big figure and 101, 500, something like it. Um, there is, I keep on being stuck on these theses that people are trying to throw around when they say, so you see the decoupling. Okay, I've talked about the decoupling from the equity market in the US, and everyone's looking at the Nasdaq. Now, okay, You want to look at the Nasdaq, you want to look at the overall benchmark for the equities in the US. Let's just for the sake of it, you know what? But let's have a look at SPX, right? So assuming the scale will help us out, but even if you look at it in the short term, right? So you see Bitcoin going for this move. You know, it looks to me like the S&P did the same. Made a low, bounced back, a little bit of a higher low, and it should higher. Hmm. What Bitcoin did instead was kind of similar, made a low, another slightly lower low, and it shoot it higher. But again, if you zoom out a bit, right? Let's say you go like this. Sure, I mean they're not always in any way trading the same way. Um, you can see that basically though, when they got deviated out relative to each other, let's say in this period right here, um, you might say, okay, Bitcoin was overperforming. Okay, and again, assuming and bearing in mind that's not the correct scale to look at these two assets, because of course the percentage variation might be different, and this might just be a misrepresentation of the actual overall relative performance. But we are just talking correlation, so we are just talking overall direction of one relative to the other, right? So now you see that Bitcoin overperformed, and it got back in line with the S&P, and then you went into a period where Bitcoin was a bit weaker while the S&P was going higher. And guess what happens? Bitcoin then catched up again with the S&P, and it got back to overperform it. Then it got back to underperform it, and this time around it's the S&P which catches out with Bitcoin to the downside. And they both spend a bit of time going kind of choppy. If you remember 2022, it was a bit of a down market, but with huge rallies here and there, bear market rallies, whatever you, up until the point they both put in the lows and they start to trade higher. And again, you start to see the same behavior once again with the S&P, which sometimes it's leading and Bitcoin it's falling behind. But then you got a pullback in the S&P and Bitcoin it's catching up. So the relative strength it's kind of shifting around. Then again, they do trade together in the segment right here. They kind of put this short-term top at the same time. Then you got Bitcoin going kind of slightly down and sideways for a few months while the S&P is still going higher. In here you got the yen carry trade scare last summer. And after that, both basically kept on going higher. And so you got to most recent times, and what you see, if you go like this, is that, I mean, basically they're doing the same. So you could say again, if you're just discussing relative strength, Bitcoin right now is relatively stronger, but that doesn't mean that the S&P is going down. Actually, the S&P rebounded. So I don't see this decoupled yet. Uh, People like to say, yeah, but the S&P needs to be priced out of earnings, out of economic fundamentals. Bitcoin doesn't. Yeah, I mean that's a good point. That's a good argument, I guess. But there is another point. Uh, if you ask anyone, they're gonna tell you why. See the contradiction there, in my view. Everyone tells you that to justify that Bitcoin should supposedly be decoupled from the S&P or the Nasdaq, or it will be into the future, right? Which again, it's a valid point. I'm not arguing against that point. But those same people will then tell you that they're waiting for the Fed to drop rates and to start to stimulate financial markets once again. They're waiting for QE to kick back in to provide liquidity for risk on assets. So at the end of it, what they're telling you is that it doesn't really matter what type of economic data you are getting off of companies which are related to the S&P, all it matters is that the amount of liquidity which is able to chase these assets higher and higher needs to be present. So they are all liquidity sensitive. It's the same for Bitcoin. If it's not sensitive to earnings because it doesn't have earnings, if it's no one like a counterparty risk, or it's kind of like a bit like gold, right? They are subject to the same type of dynamics when it comes down to the flows which are getting in or out the two. So instead of talking about decoupling, decorrelation, and whatnot, I think you should just tell, look, they both tend to go up when liquidity is present and can sustain the price. So the point of the matter is just who among the two is able to capture the most amount of liquidity which is available, right? And again, I'm not going to put back the chart right here, right now, but if you remember when we were looking at the line charts of both, when you see those periods where one is going ahead and the other one is lagging, and then you see the one which is lagging catching up, what what do you think is that? Do you think that every time it happens is because the S&P is reporting better earnings than expected or worse earnings than expected? It's again, it's just my opinion, but I do think I subscribe to the theory that the asset which is overperforming at a point, it becomes the liquidity source for the asset which is lagging. So if you got something, it's just simple portfolio theory. You trim the positions which are increasing in your portfolio. You take the profits to rebalance out your portfolio. And with those profits, you seek better opportunities in the market. So you get out of something which is overperforming, which is overextended, which is due for a pullback maybe, and you try to park those money in something which is maybe currently undervalued, maybe was out of favor for a while, so you expect a little bit of a mean reversion there. So again, even in between the two, I think the relationships that you see is that liquidity moves from one to the next, depending on the circumstances. But at the end of it, they're both moved by liquidity. There's just no escape from that simple fact. So they are both risk on assets, and they are both tied to the same type of principles when it comes down to the main driver as for price action. It's just a matter of liquidity. However you want to escape that, I don't think you will ever be able to. The money of the future, the new financial system, maybe, maybe not, doesn't change the fact that if you just buy it and sell it or own it or liquidate that because you want to make more money in USD terms, everything it's thrown out the window. Because at the end of it, even when you say, yeah, you don't need to sell it, you just borrow against it. Yeah, that's fine. Why would you borrow against it? Because I don't want to sell it. Yeah, well, okay. Why don't you want to sell it? Well, because I do believe in it long term. Okay. You could do the same with your stock portfolio then. And again, the reason why you do it ultimately is that, again, why would you even collateralize an asset in order to get what? Cash, money. But wait, if Bitcoin is the new form of money, why would I need to collateralize it in order to get another type of money? Well, guess what? Because no matter what you think, the world, and therefore the overall market, still think that this is not money. Otherwise, you wouldn't need to get a loan against it in order to get the money that you actually need to pay down your liabilities or to buy up your grocery or to pay your mortgage. So a little bit of a tangent on these. It always gets to me because, I, I pay attention to many different narratives, and I do like them. I do like them all. I might agree with some and disagree with others, but to me, the most important thing is always trying to find, those points which are actually in confluence, and there's other points which are completely in disagreement. And when you see the same points on both sides being brought up by the same people, then I just find fascinating that cognitive dissonance or that confirmation bias seeking. Uh, while at the end of it, it's just a piece of garbage. Bitcoin, the equity market, gold. Was it was it gold? It's just a piece of rocket. It's just a yellow rocket. It doesn't. Uh, Besides some industrial use, there is no use for it. But guess what? It's living one of the best bull markets ever. At the end of it, if you quote Mark Douglas, what is the main reason why price is moving? What moves price the most? It's conviction. Why do you buy something? Because you are convinced that someone else will come into the market after you and will lift up the offer, auctioning price to a new area to the upside. Therefore, you're going to make money with it. That's it. Leave out all the philosophy, leave out all the ideologies. Um, if you are in the markets to make money, I guess, especially in the short term, leave them all out. Now, in the long term, it's a little bit of a different topic, absolutely. But then you get into the rabbit hole of, these gold bugs. I own gold because if the world goes fucked. Look, if we get to the point where everyone is holding gold, the financial system is collapsing, and that's the only safe haven, there is no use for it, because at that point you're going to have difficulties and you're going to struggle just to get your hands over something to eat. Unless you do know how to hunt wild animals, at that point, all the gold in the world won't save you. Uh, you know, we are not wired up to live in the wild. So even if society collapses, if the financial system collapses, and you get back to the Middle Age, good luck with your gold. I hope you like it, and I hope you got good teeth, because it's gonna be hard to chew all that gold you have instead of actual food, right? Anyway, enough of that. A little bit of a pause, and I got back to it for the equity market, which probably is going to be another long enough segment, probably at least 30 minutes. But yeah, look, I've been away 2 weeks, so maybe you deserve it. All right. Okay, so before moving on to equities, I just forgot I was caught up in all my tangents right there. But if you remember, we were looking at gold and this little bit of a pullback after the exhaustion. So I was reading these headline by which it looks like China actually started to dump a good amount of ounces of gold starting in April. So could this be the reason why we ended up with saying a bit of weakness into gold? Because as you can see, this is basically the Shanghai Gold Exchange and the Shanghai Future Exchange positioning. So it looks like they seen a bit of outflows, so presumably positions which were closed. And since the narrative is China is stockpiling on gold, not only China, but you always hear about China, whatever, right? Um, to de-risk themselves from the US dollar or the US dollar system in a situation where the relationships in between the two countries are not so rosy, right? So it might have been a little bit of a contribution to the recent weakness in gold. Uh, I don't think this is like the definitive proof, but just wanted to throw it out there for completeness sake. Now, after that, as promised, let's get into equities, and let's start out as we anticipated with the economic calendar. It was quite an eventful week. We started out with JOLTS, so job openings, and again, we've seen that they are downtrending. They peaked out in 2022, and they have been on a downward slope ever since. Which, it's not like they're plummeting, right? You don't see a plunge, but a bit of weakness nonetheless over the past months, or at this point years. Now, uh, it's not a doom and gloom signal in and of itself. But if you look at all these data points combined with each other, they are still a spoiler, spoiler alert. They're still depicting a label market which, if it's not plunging, at the very least, it's slowing down, it's softening out a bit. What else was confirmed in the ADP non-farm employment change, which again came in lower than the previous read and lower than expected, as you can see. And even in here, starting out 2021 or middle of 2021, you see that the trend is to the downside. So another point for a weaker or a weakening, better said, labor market. Then we got into the GDP release, which was a surprise to the downside. It was forecasted at zero point 0.2. It came in at minus 0.3. Um, I look, if you remember back then, we discussed the GDP now, the Atlanta Fed GDP now, which was forecasting GDP for Q1 like minus 2%, and even lower than that. Look, at the end of it, we really didn't get to it. And it is also true that when you start analyzing the formula by which GDP it's calculated, you see that a lot of those very grim forecasts were due to, well, number one, the huge amount of gold imports into the US. But then, if you just extrapolate out, if you factor out those gold imports, you see that even the forecast for that you know survey or study calculation, it was way better. I mean, it was still negative, and at the end of it, we kind of came in line with it, a minus 0.3. So again, I remember when it first came out, everyone just freaked out. Oh, and I was having this argument like, now that can't be. I mean, you can't have an economy which goes from plus 2 point something percent to minus 2 point something percent in just a quarter. It got a bit of pushbacks, but at the end of it, if you check the establishment data now and the Atlanta Fed GDP now data now for Q1, they are a bit more in line than what anticipated. So again, always be careful with narratives and with headlines, especially those sensational type of headlines, right? They tend to be, modified, revised, and whatnot. So always pay attention to it. Sure, the figure is still negative. Now, don't want to get into the weeds of, what is a technical recession. It's two consecutive um, quarters which are closing negative as for GDP, because we've seen that that definition was revised and all the rest. But you know, it's again just maybe a testimony of economic slowdown. Now we'll see if in the coming months or for the rest of 2025 it will stay negative or maybe not. There's still, the talks about the recession risk is increasing, is it decreasing? Everyone has his own opinion on it. But at the very least, everyone kind of agreed with the fact that we are seeing economic slowdown. It was global, so it was a matter of time before a bit of that was reflected in the US as well. Now, as for GDP and getting back to the formula, it is also true that when you consider the balance of trade, right? Sure, if you got more imports than exports, that is it's a negative force on the overall GDP result. So if you import more, those imports are subtracted from the overall GDP number. And it just so happened, there was a nice chart from Zero Edge around, I've seen it, that it looks like Q1 there were a lot of imports into the US. Now, the chart, I remember, it was just representing the net exports, but of course, since they were negative, it means that you basically have more imports than exports, I guess. Why is that? Well, again, tariffs. Everyone knew that tariffs would have come. They weren't sure of the magnitude of them, but you know, it's just a measure of risk management. If you think tariffs are going to be inflationary, and if you're a company, you're going to load up on inventory now, or if you're a manufacturer, you're going to load up on your uh, raw materials or whatever input costs you have, because you know that in the future they are most likely going to be revised a bit higher. Then again, we get into the topic of, it's long-term inflationary. It's not, as for tariffs, it's not, we're not going to discuss that right here, right now. I already expressed my thoughts on it. But again, all in all, if you take the gold imports, if you take the front running of tariffs, it's no surprise that we've seen this boost in imports, stockpiling and run ups in inventories, and therefore, overall, the GDP figure came in negative in this case. Now, again, I'm not sure if that's a trend which will continue. Sure, there are many different risks out there, especially for the real economy, even more so than for financial markets. Broadly speaking, I think the real, differential, the point of equilibrium, or in case it's broken, the disequilibrium in between the real economy and financial markets, it's going to be how much an eventual recession, whether it's if it's mild or if it's severe. But the point for the markets, in my view, will be how much corporate profits could be impacted. All right. So in the case of tariffs, for instance, you might see, or you might say that they're going to be inflationary, they're going to spike, you know, uh, uh, another type of inflationary wave, and at that point, the U.S. consumers are already tapped out. They're not going to keep up with it. Therefore, consumption is going to drop. Yeah, all the rest. Okay. The point is, up until you see it, you run off of the assumption that tariffs are going to be paid off by the American consumer if he can afford them, right? So corporations shouldn't be impacted and revenues shouldn't be impacted. They just raise the prices, they blame it on the administration, and at the end of it, who's going to pay that higher cost? It's going to be the final consumer. So I guess that's what the market is waiting to verify, whether the consumer can afford to pay higher prices now, or if the consumer will just pull back, therefore corporate revenues are going to go down. If they go down, then you might have financial markets being, you know, a lot weaker than expected. I guess that's the main uh, differential there, if you want to call it that. Now, going ahead, we've seen again unemployment claims which are staying for now. For now, they're still in this range. What could be a bit more alarming, if you wish? Again, it's not critical, it's not doomy and gloomy, but if you check the continuing uh, jobless claims, then you see, although they are still around historical lows, they're kind of starting to trend up now. The problem with these type of data is that they get to be very choppy for a good enough period of time, but when they spike, they just spike. It's not like they slowly grind one way or the other. They usually move particularly sharply after they have been contracted for a good enough period of time. So I guess that's another thing we might want to keep on checking, especially the continuing claims, because the headline just tells you how many people require unemployment benefits, but you know the the most important thing in the midterm is that those people which are now unemployed can find another job in a relatively small amount of time. If they can't, you're going to see the continuing claims, which are people which are already unemployed and taking advantage of the benefits. If they keep on staying on those benefits, it means that they cannot find a job. which is a bit more damning for the overall economy because, again, no jobs, no incomes, no spending capability, no consumptions in an economy which is 70% fueled by consumption. So, again, now the ISM PMI, they came in negative once again, and it looks like we can't really break that weakness. We tried, as you can see, if you want to read it like a price chart, we tried to put together a round bottom. We failed. Another round bottom, start to get back into positive territory, failed again. So uh, even if the plan was to bring back manufacturing, for now, not so much. But again, this is not a political critic or criticism against Trump policies. It's just, even if you think it's gonna work, it's gonna take time. So I wouldn't read a lot into it. We don't know how many things will need to happen in order to see tangible results, assuming we will ever see them under this aspect. But whichever the case, even if you are super positive on these policies, don't expect that to happen overnight, if ever, right? Our average hourly earnings still a bit subdued, but they just stopped going up. They peaked out when? Well, after the pandemic, of course. The peak was around the January 2021, and after that, they've been stagnant at the very least. And then we get to the big release of the week, which was NFP. Now, NFP was curious enough to me. I said at the time, which was yesterday actually, but I said, the data is particularly neutral at the end of it. Sure, if you look at the headline, you see that the actual was 177K, the forecast was 138, the previous one was 185. Now, the market moved to the upside because, of course, the actual figure was better than expected, but still, it was lower than the previous read. And if you check the revisions, the previous read of 185 was already revised lower because when it came out last month, it came in at 228. So, then it was revised to 185, and this month, or at least for the month of April, we came in lower. We came even lower a figure which was already revised as for the previous month. So this is why I was saying, at the end of it, it's kind of neutral because, yeah, it's above expectations. But if you put it in the context of the overall downtrend and the previous month, which was revised lower and blah, 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 I mean, one positive and a few negatives here and there. So overall, not particularly cool. Guess we also had another one. Yeah, the consumer confidence. Previous was 93, forecasted at 87.7, came in at 86. So again, sentiment, it's slowing down. There are different grasps and different measures of sentiment. I guess you know you might try to look for some sort of a composite index which kind of take all these different surveys, like the University of Michigan, the this one right here, another type of consumer expectations. They put them all together and they kind of have an aggregate of overall sentiment in just one chart. And even if you check them out, or at least if you find this chart, you will see that sentiment, it's not, well, it's actually at very low levels. I guess we are hovering a lot around levels which we didn't see since basically 2021, the 2010s, the late 80s and whatnot, the early 80s and whatnot. So, I mean, sentiment, it's not particularly cool. Now, why did I want to start out with the data first? And why did I save the economic calendar for the equity, section? Because after reading that, let's say you didn't follow markets for the entire week, you would think, well, with all these kind of bad data on the employment situation, I would expect the market you know, to be weak. While instead, what you've seen is markets being particularly strong instead. So this was just to highlight a point. Just because you think a data point is negative, that is just your interpretation, right? It is actually a very, very valuable signal. If you see the market rally on the back of what, you know, normally at first glance should be considered bad fundamental news, something's up with it. And talking for experience, don't try to fade that market, all right? It's a good lesson. If the market is reacting positively to negative news, that's bullish. It's even more bullish than what you could have anticipated before the news actually coming out. All right. Now, so after this tiny little observation, that's the entire reason why I took the economic calendar for this segment. But after this, the week saw a good number of earnings coming out. Uh, Even for very important and big companies in the S&P, such as Amazon and Meta. And what was the other one? There was another one. I don't remember now, but it was particularly important. It was Microsoft, right? Okay. So earnings they weren't bad, but beside the actual figures for earnings, um, while we close down the earnings season, it's going to be much more important to check the guidance, right? So the forecast or the outlook that these companies are giving out. That would be way more important in my view. Now, why it's important that now we are close, I mean, not yet, but we are approaching the earnings season end. Well, because of course, when it ends, you got the buyback window opening back up again. And even for 2025, there is a huge amount of shares buyback which have been announced already. So, that should be support for market. That's an additional buyer which is brought into the market. Now, bear in mind as well that we've seen recently, again, flows getting back into US equities, and especially, which is a bit ironic, but it is what it is, in leveraged global equity funds. So, it looks like someone actually bought this dip. And, guess it's also very interesting to see who. It turns out that the majority of the people who bought this dip, they were your retail investors. Now, again, I'm not saying this is a bad thing in and of itself. I'm just saying that if the quote unquote smart money or if the healthy people, again, just think about Warren Buffett, right? Sitting on 300 billions of cash or cash equivalent, like T-bills in this case. If they're not buying, I mean, there must be a reason for it. Now, would you think that the retail investors all of a sudden became a hell of a lot smarter than the big guys? I mean, maybe it could be, especially in the short term, right? But it's just a warning sign in my view, because usually I would like to see capitulation where the general public, like moms and pops, um, instead of saying, I gotta buy this deep, I gotta buy this deep, that's the chance of a lifetime, right? I would prefer market bottom to be formed where, the general public is like, I need to get out. I need to get out. I'm not going to buy stocks again. That's, in my view, it's a better telltale sign of capitulation. Um, I tend to believe that for now, markets in general, if you look at the structure of the market, and if you remember a bit of recent history, we just got back at levels at which we were before the whole debacle of Liberation Day. Okay, if you remember, the market was already pricing in tariffs, but it was pricing in reciprocal tariffs. Then President Trump came out with it's his board, right? If you remember in the press conference, he was holding up this board with a bunch of different numbers. A bit hilarious, but they weren't. No reciprocal, no logical. They were just based on the trade balance differential. Which again, I mean, if you put yourself in the shoes of Donald Trump, it makes sense for the message he was trying to deliver, right? Uh, Fair trade, and again, fair, it's quote unquote fair trades. We're gonna get back to equilibrium. People robbed us for decades now. Yeah, I mean, he won the elections on that type of agenda, so naturally is pushing it. But look, the thing with markets is that they were pricing in logical or reasonable tariffs. And then when they started to see 25% on you, 30%, 60% on Vietnam, or the island of penguins being subject to tariffs, I guess the market were just, this is not what we were pricing in. This is not what we were expecting. So again, sell it all. Get out and let me reassess. I don't want to touch this thing now because they just came out with something that wasn't expected and it was kind of different from what they anticipated or telegraphed to us, the market. So after that, we've seen many different things happening, the crisis in the treasury market, and Besson having to run for the rescue a bit with a few, statements and declaration to cool down things a bit. So then you've seen the market getting back to a little bit of the equilibrium where they was before all these huge amount of volatility. There was a new after the other every single day. We got a deal. Oh no, we don't have a deal. China, it's coming to the negotiating table. Oh no, the Chinese are not coming. So, the market was all over the place because they were just trying to price in what the hell is going on. Things actually got a bit better with that 90 days pause to everything and with everyone except the Chinese. And I guess, I think Trump, to under many different perspectives, kind of backpedal a little bit. Probably, and this is just my opinion, but I guess he probably saw that. I mean, moving sharply and quickly because you want to get to results very, very fast, it might be a tactic, but he's seen the dark side of it. Probably he's seen the how it could backfire to you. Now, again, I don't necessarily say it because I don't like Trump, or I mean, I'm particularly neutral to Trump. It's just he's a politician, so by definition, in my book, he's a psycho, but and a sociopath. But it's not even my one of mine politicians. So I try to be as neutral as I can on him. I'm just evaluating and assessing what the markets thought back at the time, right? So it was quite interesting to see all these things going around. And there was a tweeter, Jim Bianco, that was particularly funny to watch. He put out a tweet by which, the the market return, depending on these statements and depending on the subject which was talking. So the returns, therefore the market reaction, was particularly negative when people like Lutnick or Navarro were talking, and instead the market tended to be a bit more relaxed, or to snap back into positive territory when Besant was talking. So it looks like, if you want to drive a parallel in between the Fed or the Federal Board, um, and the administration, it looks like Lutnick and Navarro, they are the oaks, and maybe Besson is it's the only one down in there, right? But at the end of it, I think people aren't necessarily expecting for absolute doom or absolute heaven for these markets. Uh, I do think if you start to look at them from a perspective of outcomes and outcomes distribution, look, I'm not of the opinion that we are gonna drop another 30% from here. Let's say, you know, if you try to imagine it, it would be like from peak to trough, it would be like a 50% overall retracement on the S&P, let's say. I don't think we're going to get there unless something really ugly like a financial crisis or a monetary crisis arise. But at the same time, I don't think it's going to be a smooth sail from here. So new highs, onwards and upwards from here on out. I think, the best thing that you could have in markets for the foreseeable future. So let's say the next few weeks or even the next month, especially getting into the summer. Now, May, it's not a particularly weak month, but June tends to be. So getting back to the charts, if we check NQ futures, right, maybe we can have a push into this area right here, but it wouldn't be bad for me to see a little bit of a choppy market afterwards, right? Choppy in this case for me, it would be kind of constructive again. So I think, to some degree, the reaction that we had, especially over the last 2 weeks, it's not bad, but I do think there are underlying fundamental issues with it. And still, many different kind of dossiers are open. The war in Ukraine, the relationships with China, uh, everything we have looked at, the labor market, or these infamous interest rate swap spreads being massively negative now. So I don't think we're out of the woods yet. Sure, this reaction from market, it's better than nothing. Actually, it's particularly positive, same as Bitcoin, right? Um, if you check, for instance, these other layout, I guess it's nice to see that at least we worked on a higher low. We got back above the 21 exponential moving average. We tapped back into it and we immediately bounced off of it. And we got back above what was the green one? The 50, 55, probably still exponential. Now, the next level of resistance, which is kind of in line with this pocket right here on NQ, probably even on the Nasdaq, 5,800 or slightly below it. But the next pocket would be the 200 days moving average. The last time it was a rejection area. This time we'll see. NQ is already there, to be fair. So again, we'll see if we can crack it at this second attempt, or if we see a little bit of a rejection off of it. Now, I guess the point now could be, look, if we can clear these moving averages out, so the 200 days in purple and the 100-day moving average in white, maybe at that point we can say, the pullback, the correction is behind us. We can get back to be bullish for new highs, and maybe at that point I would start to believe that we we get good odds of it. Um, at the same time, though, the problem with me is that since, as I said, to me, this year started out with a lot of vibes of 2022. Even if we manage to trade above this high right here, or this high right here, I would still concern about a potential bear market rally. Bear market rallies tend to be particularly violent, and they have a good magnitude in terms of price excursion. They can rally like a lot. 10-15% wouldn't be really something you've never seen before, especially with a VIX, which is still, although it came out like a lot, but it's still above the 20 level. And now we get that trend line, which originated on the first leg down. It was retested on this pullback. So I'm kind of interested in looking at what happens if the VIX can, get back to 20, basically, because now we got the 20, which is the level I refer to usually, and it would coincide with this trend line on the recent upward trajectory as for the VIX. So I I would be much more bullish if we could have the VIX getting back to trade in a stable way and consistently below 20, while the market keeps on uh, trading to the upside at this point. By the same token, getting very short term, for now, I'd say these tests in the 21 exponential moving average would be a nice risk management type of a level for me. So let's say if we get back below it, at that point, I would expect over time, probably not in 1 week, but over time, I would expect a bit of a revisit of the lows. Again, not new lows maybe, or not right away, but at least a run toward the old lows. And then we'll see from there. It could be we have actual continuation, and this is confirmed to be a bear market rally, and we are in a bear market, or we see if we can manage to work on a double bottom, kind of like we were talking about with oil, right? But very short term for now, overhead resistance, this area, 5,800 more or less on the S&P. Nasdaq, it's a bit more volatile, so I would say 20,700. It could spike to 20,800 as well, and being rejected there on a closing base, right? So that would be the range to the upside, very, very short term. To the downside, invalidation would be this point, so 5,450 on ES, and well, let's call it 19,000 even on NQ. If we get rejected below these two respective levels, at that point I would shift back to be bearish on on an intraday base, on a very short term base. All right, not talking 2, 3, 4 months out. Okay, that would even if you believe that, you would need to wait confirmations for it, especially both from the chart and your fundamentals indicator, right? That would be my take on it for now. So, well, what else? I guess there's really not a lot to say other than that. I mean, we could zoom in on the hourly time frame, very short term. What do we see? We still have this gap, which is not bad. Well, but I guess it just provided the support it needed to, both in here, in here, in here. I did like this sharp drop. When was it? Yes, it was April the 3rd. So yeah, Wednesday. I mean, again, it's the old same logic. You got a deviation out, peak up of liquidity, and the market immediately snaps back to the other side, and it gets bullish. The close for the week, I mean, we close near the highs, so it's not bad. Um, and the US session was particularly bullish overall. So again, this is why I'm saying probably a bit more of upside starting out the new week. Um, just remember, next week we are going to have FOMC on Wednesday. So we'll see what Powell is going to say. On that topic, let's have a look at something before wrapping it all up. Um, so first of all, let's have a look at the. So over the last 5 days, okay, refresh it. Right. 5 days, so last week of price action, everything was bullish except energy because we've seen oil. All right. As for the month, last 30 days, the energy was massively down, technology rebounded, but it was also the most beaten out in this recent drop. Healthcare came down. It's a bit of rotation, maybe. Real estate, not a lot. Financials, over 30 days period stayed relatively stable, I'd say. So, I mean, at the end of it, again, we just mean reverted the entire month where we dumped. Um, we got a new update for the GDP now. Let's see where Q2, where are the estimates? A little bit above 1%. It's right at the edge of positive versus negative territories. But as for the FOMC meeting, I want to check the Fed Watch tool and see what type of expectations the market is pricing in if we can load it up. And unfortunately, we cannot. But this is unfortunate. I mean, if it doesn't load up, I can tell you on the top of my head that as for this meeting, the odds of a cut was basically zero. It was like maybe 2.5%. Yeah, there you go, 2.8%. And the odds of rates staying where they are, it's 97 point something percent. As for May, let's just try to look at June. Again, June still no cuts for the majority, but a little bit of increase in potential cuts. As for July, well, wait, July is actually okay. July, it's pricing in a bit more of a cut, not just 55%, but it looks like the market overall, it's putting itself together, and the odds of cuts in the coming months are increasing. So we transition from pricing in no cuts to then 2 cuts, now probably 4 from here to year end. So I guess the market, it's reacting positively. So again, the problem was, the data weren't good, but at the same time, I know it's a bit perverse, but if the data are not good, then bad news are good news, because it means that the Fed will support the market, dropping rates, providing liquidity, maybe even stopping QT and getting back to QE, right? If the economy is deteriorated so much. Still, that point about how much will impact corporate revenues, it's a little bit of a bug in my head. But, again, for now, short term, probably a bit more of a push, and then we'll see. And overall, a bit of sideways, it wouldn't be bad in my view at this stage right here. Like maybe not a huge amount of time, but maybe 1 week, 2 weeks, and then we'll see what happens. But yeah, that would be it for me. Don't think there is anything else I wanted to discuss. I guess I basically said everything. Again, a bit of a long video, but at the end of it, you have been without me for 2 weeks, so I hope you were detoxed enough. All right, with that said, wishing you a very good weekend, very good Sunday, and a good start of next week. Pay attention to FOMC. Don't be caught up in the volatility, which most likely we're going to have. And other than that, be nice and be cool as usual. Needs out.
Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Get the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.